Traders at UBA say they expect investors in Nigeria's fixed income market to continue to act on the expectation of high yields by staying away from longer duration amidst volatility. Bankole Odusanya, the head of fixed income trading at UBA, joins us now to unpack that a little more. Thank you so much, Bankole, for joining us. So, just to be clear, your expectation is that we're going to certainly see higher yields. Is that really on the back of the inflationary trends, or are there other factors at play here?
Yes, thank you, Wale. The expectation is of higher yields simply because of inflation as one major factor, and then the situation in which the Debt Management Office and the Nigerian government is given all the challenges it faces and how much it needs to raise. Of recent, you've seen that the government has approached the legislature with over 2.3 trillion need to borrow from the foreign exchange market, and that we know that they are trying, the Debt Management Office and the government is trying to raise about 1.5 billion from the IMF. And in trying to do that, we've seen the convergence that the central bank has just achieved in most of its official rate versus NAFEX rate. This has been achieved, going forward, going into meetings that we expect to happen next month, before the end of H2. So basically what's driving the market is yield expectation. As we speak, NTB yields are at 9.65, where it stopped this week, but the effective yield is at 10.7. For bonds, we are at between 13.8 and 14 for bonds longer than the tenor of 2036 to 2049. For bonds shorter than that tenor, we are trading at about 12 to 13%. That's double digits. Even the effective yield on treasury bills is at double digits. So basically, that's why you also see a lot of funds leaving the equities market and returning to the fixed income space, because the yields are better, but the expectations are still higher.
All right, so that yield curve is looking like everything is firmly in double digits right now. But how much higher do you think yields can go? With inflation at 18%, and I think the expectation generally is that even if it were to fall, maybe 1 percentage or 2 percentage points lower. So it's still very high double digits. And in that context, one can expect, I imagine, that yields will continue to trend higher.
Yeah, thank you, Wale. You have asked two questions. The first one is that how high do you think fixed income yield will continue to push? For bonds, when we get to the fringes of higher 14% or 15%, one would begin to see buy pressure. That's the bullish run. It is historical that when Nigerian bonds get to 15 to 16%, it hardly stays there for 30 days. It's historical for at least in the last decade. So usually there's a lot more interest at higher than 14.5 to 15 and 16 level. So we expect to get that sometime this H1, but we do not expect that to last into H2, and then the bulls will be running off the equities market fully into the fixed income market, and then you expect the PFAs, who have been accruing a lot of coupons and fresh inflows from contributions from payee, to bring in these fresh funds into the market, because right now it seems as if they are playing heavily in the term deposit space, waiting for yields to peak. So basically, we expect funds to come into the bonds market when we touch 15. As for Nigerian Treasury bills, we saw a decline in stop rate for the Nigerian Treasury bills from 9.75, where it stopped on 2 occasions, to 9.65. So it seems that on the Treasury bill side, there may have been a peak, even though the effective yield is in 10%. We're not expecting yields to go to 11. The OMO has stopped at 10.1. The NTB is at 9.65, effective being 10.7. So we expect that has peaked already. But for bonds, there's still some room for improvement in our opinion.
Right.
The second question you asked was about inflation moderation. We do not expect moderation anytime soon. What you saw at the last result from the NBS was simply base effect. Last year had high base in pricing. So just base effect. If you look at what we are hearing now about flour pricing and the impending rise in the price of bread, and then a possible removal of petrol subsidy, and the multiplier effect of that, those two, we will expect that on the long run, prices could inflation could remain at 18 and above, or even touch 20%.
That's very valuable analysis there of the whole spectrum of the market. Oh, but let's talk a bit about the short term now. So we're talking liquidity in the markets. Obviously, we know FAC allocations have come in and they've supported the market a little bit. But how do you see things trending into next week?
With liquidity, the central bank is very, very, very determined to continue to use CRR as its number one tool of mopping up liquidity. Initially, it used to be OMO instrument, but apparently on the long run, I mean, if you, in hindsight, it's turned out to be too expensive. So the central bank, we believe, is using CRR to mop up funds to manage the amount of liquidity that is available in the system that could have accelerated inflation or pushed further the demand for FX. So basically, we expect that we don't expect any change from that. Just like we saw at the Monetary Policy Committee meeting, where all stances were maintained. So basically, liquidity will continue to be mined by CRR, and the central bank is very, very determined to ensure that the system is not having too much liquidity than it needs.
A very useful insight. Let's talk briefly about the forex markets and the trends that we are seeing there. So I think the good news that I'm hearing now is that the central bank has really improved in its support, in its provision of foreign exchange across the curve in terms of for retail investors, for industrial users, and so forth. Of course, they can always do better, but there's clearly been an improvement. But what do you think all that would mean for, say, for example, the parallel market rate, where we've seen that inch up a little bit over the last few days? Many are pointing to this move towards the NAFEX rate as the reference rate for the central bank. Do you think that will be a short-lived movement? How do you see things playing out?
Yeah, the convergence is good news. I mean, it just means that if they've met that as a conditionality, more funds could come in from the IMF or from FDIs who had waited on the sideline simply to see the convergence and some other benchmark being moved. It is also very true that the central bank has intervened more. The NAFEX volumes have changed. I mean, if it has increased seriously compared to Q1. I mean, we're in Q2. And then going into the rest of the year, with where crude oil prices are, we expect some marginal improvements, of course, in the way they intervene, basically. So for the FX side, it seems as if the movement will be marginal improvement rather than a decline in supply.